In life, there are no perfect solutions. There's always trade-offs. That's a quote that's been stuck in my head recently because I think there's a lot of truth to it, especially in the realm of personal finance. Investors need to balance risk with reward. Budgeters need to balance their wants and needs against the reality of their income. And those seeking financial independence need to balance their goals against the weight of financial history. We can't just snap our fingers and achieve sky-high returns or double our income, as nice as it would be. There's almost always some sort of trade-off that needs to be made to achieve a financial goal. And sometimes it can be helpful to view our personal financial decisions through this trade-off-centric lens. Because if we know what trade-offs we're actually making, we're far less likely to regret our decision later on down the line, even if our decisions ultimately end up with us falling short of our original goal. And it can be surprising just how wide of a range of possibilities there are when we consider what we're willing to work with in order to achieve our goals. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. A great situation to analyze trade-offs is financial independence, because there are just so many things you can consider doing to better your chances of successfully extending your nest egg throughout your retirement, but they all come with their own trade-offs. So here are some of the assumptions behind financial independence and how those assumptions present you with several potential pathways to choose from depending on which trade-offs you're willing to live with and which you aren't. There are many ways to achieve financial independence. In the olden days, probably the most common was through some sort of pension from your employer. Nowadays, that route is a bit less common, though it does still exist in some areas. Another way is to form some sort of passive income stream, perhaps through some sort of royalty income or real estate business. But probably the most common approach in the modern day is through saving and investing your own money to build up a nest egg that you can then draw from to make up any gaps you may have after spending things like Social Security in retirement. In the interest of time, and since the nest egg approach is arguably the most common nowadays, that is the one I'm going to use for the remainder of this video, but keep in mind there are other potential pathways that you could consider exploring. Some of the most common baked-in assumptions often associated with the nest egg approach is that you will need to determine how much of your nest egg you can draw on in retirement so that it doesn't run out before you do. This is often referred to as a safe withdrawal rate. 4% is a pretty commonly used ballpark estimate, not necessarily because it's inherently applicable to all people in all situations, because as we'll see in this video, it absolutely isn't, but simply because it was the rate that was found to be reasonably safe historically in one of the earlier studies on retirement planning that has since become one of the more widely known studies on the topic. The study in question was conducted by retired financial advisor William Bengen, who found that based on the market returns and inflation data he had available to him at that time, and the asset allocation that he used, you could reasonably expect your money to last you at least 30 years if you withdrew 4% of your nest egg in the first year of retirement and adjusted that withdrawal amount every year thereafter for inflation, as measured by the CPI. But as I'm sure you've already picked up on, there are several assumptions baked into that premise that may or may not apply to your own personal financial situation. For instance, in addition to the obvious assumption that the retiree will follow the rules laid out by the strategy, there's also the assumption associated with the time horizon. 30 years is a pretty standard starting point in retirement planning software, but it may not be the right time horizon for you. If you're retiring super early, like in your 30s or 40s, you'll probably need to plan for a longer potential retirement, in which case the safe withdrawal rate might actually be lower than 4%, even with the same asset allocation, and vice versa if you work until you're older. Another assumption is that your expenses will change over time in line with inflation as measured by the CPI. Sometimes this may be pretty darn close to true, but other times it might not be. Expensive one-off purchases like new cars or vacations can throw this assumption into question. The same is true if a large portion of your budget goes towards costs that don't really scale with inflation, such as the principal and interest payments on a fixed-rate mortgage. It also implicitly assumes that the CPI in the future will change in ways that are roughly consistent with what we've seen in the past. In other words, it assumes that we don't experience true hyperinflation, or something similarly historically unprecedented for that particular dataset. For the record, this same assumption applies to the historic market returns that Bengen was studying. Strong returns are fine. They obviously will not break the logic behind this rule. And the same is true of poor returns, so long as those poor returns are not so severely poor or long-lasting to be historically unprecedented for that particular dataset. Beyond that, there's the asset allocation assumption. If the allocation used in the study doesn't match your own, that could change the resulting safe withdrawal rates. sometimes significantly. Regularly rebalancing the portfolio to ensure that your allocation doesn't drift too far from the initial starting point over the years is also a common assumption in these studies. Finally, there's the assumption that the retiree desires historical certainty in their safe withdrawal rate, which is probably reasonable in most cases, but it won't be the case for everyone. Some people might be willing to trade that historical certainty in exchange for being able to utilize a higher safe withdrawal rate, and thus be able to retire sooner. This may mean that they have to re-enter the workforce at some point if they're unlucky enough to hit a particularly rough patch of returns, but again, for some, that's a trade-off they're willing to live with. Then there's also the assumptions that are not explicitly stated, but are nonetheless implied, such as the idea that our psychology and emotions won't get the better of us when the markets are gyrating up and down over the years, that we will not do things like pick up part-time work or temporarily cut our spending during down markets, that we don't plan to leave anything for any kids or causes that we may support, that tax laws and investing expenses will not materially change and alter the results for better or worse, and so on and so forth. All of these considerations have the potential to alter our safe withdrawal rate, and in some cases quite drastically. With that being said, let's talk some numbers. Let's say that John has reached retirement age and has a nest egg of $500,000 put away for retirement in a simple total stock market index fund. He has Social Security income of $1,500 a month or $18,000 a year, and in years following market crashes, he will pick up part-time work, which will net him an additional $12,000 in those years. In terms of his withdrawal strategy, he will stick with that simple inflation-adjusted approach used in Bengen's original study, and will assume a 30-year time horizon. If we look back through history, going back as far as the data I have allows me to, which in this case is 1927, what kind of income do you think this scenario would support? The answer, at least based on the historical return and inflation data I have available to me at this time, is about $41,250 before taxes and investment-related expenses are taken into account. Since we're assuming he's investing in index funds, the investment-related expenses are probably pretty minimal. For example, Vanguard's Total Stock Market Index ETF, ticker symbol VTI, has an expense ratio of 0.02% at the time of this recording, which would come out to be about $100 or so per year on a $500,000 investment. Taxes could either be significant or virtually non-existent, depending on a variety of factors, including what type of account John's investments are held within. In the interest of time and simplicity, I'll assume that John's money is in a Roth retirement account, so the taxes on his withdrawals will be zero. But this is definitely another factor to keep in mind when running your own numbers because it can make quite a big difference to how much spending money you actually have. Now, it's important to keep in mind what trade-offs John is making here. He has a pretty aggressive asset allocation, 100% stocks in his late 60s, and he's technically saying that he'd be willing and able to pick up part-time work following down markets at any point during his 30-year retirement. That might not be possible depending on his health in the later years, which, if he's particularly unfortunate when it comes to his investment performance, could lead to a less than stellar ending for him financially. That is by no means a guaranteed outcome, of course, but it is something worth noting. There's just not a ton of wiggle room when you're withdrawing that large of a percentage of your portfolio every year and your allocation is a more volatile one in the short term. That uncertainty is another trade-off he's making. If we kept everything the same but changed the assumption about John picking up part-time work in the years following down markets, his sustainable historic income would drop from a little over $41,000 to just under $36,000. If we held a more conservative asset allocation, such as the permanent portfolio, which holds not only stocks but bonds, cash, and gold, John's sustainable income would drop further to a little over $34,000. So John's portfolio would become significantly less volatile, and he wouldn't have to worry about picking up part-time work when he's 95, but the level of income he could historically sustain safely would be lower. As you can see, these trade-offs can make a pretty big difference. Let's take a look at another hypothetical. Let's say that Jane also has $500,000 in a nest egg and will initially withdraw $40,000 to live on in retirement, adjusting for inflation over the years, just like John. She has her money split between a small cap value index fund, a total bond market index fund, and gold. 70% of the money is in those stocks, and the other 30% is split evenly between the bonds and gold. Maybe not the most well-balanced allocation in the world, but for the sake of this example, it can help illustrate the overall point. Jane also has some money in cash outside of her portfolio, in this case totaling about $48,000, or 2 years' worth of her bare-bones essential expenses. It helps to have a paid-for house in retirement. Jane has decided that she's willing to live on these bare-bones essential expenses in the years following market crashes instead of picking up part-time work like John did. The cash is kept in a high-yield savings account earning roughly 4% interest. This money will be her first line of defense, so to speak, when the market crashes. She'll use it to cover her expenses for as long as she can while the market is down. But once it runs out, it's gone. She'll also be utilizing a combination of an inflation-adjusted spending ceiling and financial guardrails to ensure that her spending never gets too high or too low relative to the current size of her nest egg. She'll never allow herself to spend more than $40,000 on an inflation-adjusted basis in any given year. That's her spending ceiling. And anytime her withdrawal is greater than 9.6% of her current portfolio value or less than 6.4% of that value, she will adjust the withdrawal amount up or down by 10%. She has no income from Social Security or any other sources beyond her portfolio and cash buffer. Here's a snapshot of her retirement spending chart to give you a general idea of what this might look like. This is from the 1969 start year, which was one of the tougher ones in this scenario. As you can see, Jane starts in year one by withdrawing $40,000, but because the market immediately starts to struggle, she has to drop down to her bare bones expenses over the next couple of years. This ends up eventually exhausting her cash buffer. In year 4, she doesn't quite jump back to the original $40,000 inflation-adjusted withdrawal because her guardrails have kicked in during those intervening early years. Of course, not all starting years looked like this. If we were to take a look at one that was a bit more favorable, say 1932, when the worst of the Great Depression in terms of returns had already passed, we see a much different story despite the exact same assumptions being used. Most of the years, Jane's income is a static $40,000 on an inflation-adjusted basis, with just a handful of years dropping down to those bare-bones expenses. Those two potential outcomes are just what can happen due to sequence of return risk, which is why it's important to consider that when looking at trade-offs and planning for retirement. Would you be okay with having your income fluctuate as much as Jane's did in that 1969 hypothetical? Because while it may be an extreme example, chosen to illustrate the point, it is something that has happened before and could happen again. Just like the 1932 scenario, where most of the years the income is right where Jane would have anticipated it being all along, with just a few aberrations. Again, it's all about deciding what kinds of trade-offs you're willing to live with. Let's run one more hypothetical. Let's say that Bob is in a pretty similar situation to Jane. He has a $500,000 nest egg, and his asset allocation and bare bones expenses are identical to Jane's. However, he doesn't have a cash buffer and he isn't using any financial guardrails or spending ceilings. And instead of using the standard inflation-adjusted approach for his withdrawal rules like John and Jane did, Bob has opted to just withdraw a fixed percentage of whatever his current nest egg value is at that time. To keep things consistent with Jane's example, we'll assume that the percentage Bob uses is 8%. So in the first year of retirement, he'll withdraw 8% of $500,000 or $40,000 in income. And every year thereafter, he'll withdraw 8% of whatever is in the nest egg. As you would expect, Bob's income fluctuates quite drastically compared to Jane's. Heck, in some years, he even got close to a six-figure inflation-adjusted income. However, unlike John or Jane, in one of the starting years, Bob actually does run out of money before the end of his 30-year time horizon. It was in the 1929 start year. Bob fell just barely short in the 30th and final year of that simulation, only being able to withdraw an inflation-adjusted $10,500, which would not have been enough to cover his bare-bones expenses for that year, which, remember, were $24,000. So in addition to the trade-offs of having a highly volatile income from year to year, sometimes for the better, sometimes for the worse, Bob is also making a trade-off when it comes to historical certainty, because while all but one of the historical cases in this particular dataset did manage to survive at least 30 years, the one starting just before the onset of the Great Depression didn't. So if Bob was remarkably unfortunate enough to experience investment performance similar to that of the Great Depression, he might be in trouble and have to pivot his strategy. Thankfully, as we discussed, there are many options available for him to do just that. So there you have it. That's one of the reasons why personal finance is so, well, personal. Depending on the trade-offs that you're willing to live with, you can get a pretty wide range of results, even from very similar strategies. So especially when it comes to big decisions, always take some extra time to consider the full range of options available to you. You may just be surprised at what is really possible. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. If you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.